And here I'm seeing large cap inflows pretty muted for the third straight month now, but there were strong flows seen in flexi cap funds as well. And overall, if you look at thematic NFOs, the kinds that were launched, they have helped equity inflows. Equity inflows, of course, are making these highs, especially when you look at non-SIP inflows, which have been creating new records. After 7 years, now we are seeing non-SIP flows really rise. So why are thematic funds also creating this buzz is one question, but whether SIPs make more sense or lump sum investments, which is the wiser choice, let's discuss this threadbare. To do so, Mayuresh Joshi, the head of equity at MarketSmith India, joining us along with someone who tracks the personal finance universe very closely, PV Subramaniam, back with us. He, of course, the CEO of Subramani.com. Great to have you, gentlemen, on this discussion. Subra, coming to you first, how do you read into the rise of non-SIP inflows? Who are these investors who are putting in lump sum money when the markets are at the kind of highs that they are?
See, markets are not okay. After some time, this won't get a high, right? At 80,000, like, oh my God, it's a new high. At 90, you will forget that you thought 80 was a high. That's the story of India. Vikram, when I came into the market, there was no index. Then the index came at 100. At every stage, 10, 20, 30, 40, 70, 80, I've been asked, now what will happen? We have no clue. Inflows are coming. See, one more thing you have to remember, like a car launch, when the product is launched, the 60% or 70% of the total budget ever spent on that product on advertising is spent at the launch. After that, there is no expense, right? So everybody tries to make a push and say, oh, manufacturing is the theme, mid cap is the theme, or something like that. And there is a heavy push. The NFOs are better commissioned, so everybody goes out and sells it, and people invest. So yeah, there is an inflow, there is an SIP inflow, and there is a lump sum inflow. Both are happening, and the market is going. It's a big picnic. They don't want anybody to disturb it.
A big picnic, but like you said, you entered the market when there was no index, really. But if you look at the action right now in the month of June, Mayuresh, it's been a topsy-turvy ride, hasn't it been? Of course, the India VIX reflects that as well. The impact of election results have played out, and we've seen the sharp dip as well, then a quick rebound in the benchmark indices in the first week of June. But looking at the kind of story that is developing on the SIP front, are investment patterns among retail investors changing according to you?
Evening, Vikram. Oh, absolutely, yes. And I think the entire context in terms of Indian savings, did a large part of 2020, 50% of savings were parked in real estate assets, around 17% in fixed deposits, 17% in insurance products, and only 4% were in equity investments as well. As the cult is growing and as the expectations are growing louder in terms of how wealth can get compounded through equity as an investment mode, I think millennials as well as the old timers who have always stayed with equity markets, a combination of all these factors is creating the huge liquidity impetus that the equity markets are probably getting. So do we see a sudden shift or a gradual one in terms of the assets that we own and the ownership of Indian equities, which is way below the global average at this juncture? I think liquidity in terms of SIP flows as well as thematic flows will continue in the Indian context. With the mutual funds and the distributors and financial awareness being spread out towards the retail investors in a very simplistic language, we are making it clutter-free from the financial jargon that we probably use. I think investors will probably jump into this bandwagon even more over the next few years. So I think the number will keep on increasing, in my opinion, as far as SIPs are concerned. And that is a healthy sign. The only thing to be noted, Vikram, here is return expectation. I think that should remain moderated, because what we've seen in the past couple of years in terms of the stupendous returns that the markets have given, both large caps and even more so mid caps and small caps, that will normalize going forward as well. So to that extent, yes, SIPs will continue growing.
Mayuresh, why do you think we need to moderate our expectations? What's the fallout if we don't?
So markets, Vikram, never move in a linear fashion. So I think what we are probably seeing in this liquidity-driven rally, there will be events over the next few quarters, next few years, which will pull down the markets to a
And what
certain
will happen
extent.
because of that, you
And therefore,
suspect?
you have to moderate your return expectations. They have to be reasonable enough to beat inflation by reasonable much.
Right. But Subra, overall, in the month of June, most inflows have been, you were talking about NFOs. I'm just wondering if there is a correlation. So many funds have come up in recent times. But the kind of inflows we are seeing in sectoral or thematic and also multi-cap funds, that's where the most inflows have been seen. Is it safe to assume that a larger quantity of the non-SIP inflows, when you compare it to SIPs, have gone into these funds? And is there a link between these two, the non-SIPs and these sectoral and multi-cap funds?
Yes, of course. It is hugely incentivized for the distributors and for the AMCs to get lump sum into any equity fund during an NFO. Okay, if you ask me to put money in, if you were my client and you said you want to put money in a multi-cap fund, I would suggest that you should do an SIP, because why take so much of risk? Because it has got large cap, mid cap, small cap. So let's put 50,000 a month or 10,000 a month, whatever. But I'm incentivized to bring 5 lakhs, 10 lakhs, 20 lakh checks. So obviously the incentives work. And like Warren Buffett says, see where the money speaks. So you're incentivized to bring lump sum, people will bring lump sum. And there is proof that, say, look at our defense fund. It has got 140% return last 1 year, sir. Lump sum is better. So yes, lump sum is incentivized. Lump sum will be the story. I have no clue what should be the return expectation, because earlier we used to have very heavy return expectations, 28%. Now we have moderated down to 24%. So 24% is now considered moderate. So that I think is going to be, of course, I'm being sarcastic. I don't want somebody to clip this and say
You are being
expectations.
sarcastic. 24%. And
Expectations don't come
Mayuresh was
down.
just talking about unrealistic expectations and how we need to moderate them. And I think when you talk about 24%, there is definite need for moderation.
Yeah,
So,
but
Brad, making
140
my
is what a
task a little
defense
bit
fund
more
is given.
difficult by ensuring that I choose stocks that deliver returns in excess of 25% in a year.
Right. But Mayuresh, do tell us, because of course, like Subra is pointing out, there is heavy marketing when you talk about some of these new funds that are coming in, whether it's new funds or not. How do you compare lump sum investments with SIPs? Because the saner way to do it was SIPs, and there was a reason why it was happening that way. But you're seeing that much more lump sum investments too.
So, Vikram, to answer that question, I'll break it down in two parts. Obviously, SIP is the best way to probably have your investments done in the equity markets, because that reduces the market volatility and your impact cost if the market goes through phases of ups and goes through phases of declines as well. Now, what has really transpired in the last couple of years, Nifty, as an example, from an index perspective, has not given a correction of more than 5%. So I think there were so many people waiting on the sidelines, waiting for a more structural fall to probably come in so that they could probably invest at some point of time. And this feeling of missing out is largely still existing among a lot of investors, retail investors, ultra net worth individuals, and even high net worth individuals as well. So I think they're lapping up an opportunity in terms of as these thematic funds are getting launched to probably go into the market in terms of the missed out factor or the element that they've probably missed in the last few weeks or last few months. But I think a lump sum investment is always better when the market dips significantly. That is where I think a bulk of your money is probably going. And you're not really sure at that point of time whether the market is going to revert back to mean in the next few weeks or months. But I think the last 2 years have been disruptive. And this missed out feeling is probably attracting a lot of investors, even into a lump sum mode as far as thematic funds are concerned. But I think SIP is the more saner way, in my opinion, to probably go.
So we have a logical explanation over here, Subra, as to why we are seeing this kind of pent-up need for investment, and which is why we are seeing the rise in lump sum investments. To you, as a personal finance expert, leaving aside all the sarcasm, Subra, tell us what you think really works. Because definitely, like Mayuresh is pointing out, it's in dips in the markets that perhaps lump sum makes sense. But we haven't seen that kind of sharp dip which justifies lump sums. How do you see it?
Vikram, the problem with equity returns is it is lumpy. Okay. So if somebody comes and tells you I got fantastic returns from say March 2020 till today, believe me, 80% of the return or 70% of the return would have been made from March, April 2020 to September 2020. That was the steepest one. After that, the 4-year returns don't look bad, but that those 4 or 5 months, you would have got something like a 60%, 70% kind of a return. And that is getting divided now by 4 years. So it looks good. But I also understand for 99% of your audience, or maybe 98% of your audience, SIP works because they are salaried people. But when you go to a HNI, he's not thinking in terms of a SIP. He's got lump sum. So he sells 10 crore worth of one share and buys 10 crores worth of another share. So he will always be in lump sum. And also, see, if I came and told you, you need X amount for your retirement, so please put away 2 crores today lump sum, and you're going to laugh and say, I don't have 2 crores to invest. So I'm going to tell you, okay, 50,000 SIP or 30,000 SIP or 70,000 SIP will work for you. You say, that makes sense because I'm a salaried employee. That's not true for the HNI and the ultra HNI. They have cash. They may correct, right? They may just pick from one fund and switch. They're not investing new money. They could just be switching from a debt fund to an equity fund, or they may have sold some real estate. They're putting a lump sum. So it's very common to see people doing 1 crore, 2 crore kind of investment lump sum because their net worth may be 30, 40 crores. So for them, lump sum makes more sense. Even for you, lump sum would make sense if you have the money and you have a 20-year view. However, if you're a newcomer and you put in 2 crores, 10 crores, something, whatever, 20 lakhs, and next week the market falls by 10%, you're going to get alarmed and say, oh my God, mera loss ho gaya. To prevent this, which is 99% of your audience, SIP makes sense. But for people with lump sum and the ability to sit through 20, 30 years, for them, lump sum is definitely going to give better returns. So they are doing that. But largely what you said, so much of marketing, every day there is an NFO, 30 days, 30 NFOs, right? So obviously they're looking for lump sum. They're incentivized for lump sum, not for SIP. SIP opens after the NFO closes. After that, the SIP comes. But till then, if they have to collect, 9,000 crores is what one manufacturing fund collected. That is 9,000 crores lump sum.
Correct.
Not an SIP.
Yes.
Right? So
yes,
that
it's substantial.
happens. That happens.
And all these funds that are coming
NFO.
through, Mayuresh, we are running out of time, but when you look at these new funds, are they aligned with the need in the market right now? These products, these offerings that are coming through, how innovative are they? Are they more of the same, or are we seeing them realize the market dynamics, the changing way that we're seeing growth as well, the prospects of growth in the economy? Are they reflecting that? And that makes the case for investments in the NFOs.
That's possibly the base case scenario, Vikram, because I think everybody's trying to write the India story, which in my opinion and everybody's opinion should continue for the next few years, the next decade as well. And therefore, they are maintaining their stance of earnings compounding at a decent pace, the India story probably growing better and faster than any other economy in the world. Not much of innovation, but I think the kind of IPOs that are hitting the market, Vikram, I think what I was also reading through is that there are substantial number of IPOs planned for the next couple of quarters as well. So there are plenty of opportunities, both in terms of capital raising that promoters are doing, entrepreneurs are doing, investors are flushed with liquidity at this juncture. And I think mutual funds are making hay while the sun is shining at this juncture.
How far this goes, because we are seeing this rise in SIPs, but now non-SIPs as well. Thanks very much, Subra and Mayuresh. Always enlightening to have a conversation with you about the state of the markets and the way investments within the personal finance realm are panning out. Great to have you on India Tonight.
If you like this video, then like, share and subscribe to ET Now.